Hi everyone, I am your portfolio manager Rajiv Dixit. In my last Outlook video, we had highlighted the fact that now is the time to plan for your taxes. Planning for taxes in the last quarter of the year is very valuable because there are things you can do right now that can help you save on taxes for this year. For that purpose, we had promised you that we would bring in a guest speaker who can guide us through the process of strategizing for our 2021 taxes. Today, we have the pleasure of speaking to Mark Kovaleski, a person that I have relied on for complex tax strategies and tax planning. Mark is an exceptional source in this field. He is the managing partner of one of the most successful accounting firms, Mengel Metzger and Bar. Mark's knowledge in the field of taxes is extensive. He has worked in the field of accounting for 30 years. Mark belongs to the American Institute of Certified Public Accountants and the New York State Society of Certified Public Accountants. So, welcome, Mark. Thank you for taking the time to sit down with us today.
Thank you, Rajiv. It's a pleasure to be here. Before we start, I just want to let everyone know that this advice I'm giving is generic in nature. Each one of these topics that we discuss could be its own section. So it's very important for everyone to discuss with their own personal tax advisor their particular situations before they make any of these moves to potentially save now on taxes or in the future.
Yes, that's very important. So just to give you an idea, we're going to break up this discussion into two different sections. The first section will focus on strategies related to individuals, while the later section will touch upon strategies specifically designed for small business owners. As you can imagine, charitable donations is one of our clients' favorite strategies to save on taxes and make a difference in the community. But many times, they realize the contribution that they have made do not count as a deduction towards their taxes. Mark, can you help us understand how the deduction works, the limits, and what we should be aware of, or any other details regarding this important deduction?
Absolutely. Great question. Everybody likes to contribute to charity, but they also want the tax deduction for it as well. So let's break it up into two different areas. One, if you take the standard deduction, and one if you itemize. So typically, historically, in the past, you've had only taken a charitable deduction for if you itemized on your Schedule A of your tax return. That's different now. So now we have a standard deduction that you could take. Those amounts are $12,950 for an individual and $25,100 for someone filing a joint return. In addition to the standard deduction, you're now eligible to take a further donation for charitable purposes of up to $600. That's $300 if you're filing separate and $600 if you're filing a joint return. So that's in addition to what your standard deduction is, as long as you're making those contributions. If you itemize, that's even could be more beneficial for you. So now if you're itemized, you're allowed to take 100% deduction of your total AGI. So if your AGI, that's adjusted gross income on your tax return, for example, is $1 million, you can make $1 million contribution to the charity of your choice and have no federal tax liability. So very advantageous and something that's evolved over the last few years. So things you need to consider when making these donations is one, it has to be to a charitable organization, an approved charitable organization. So that's basically a 501c3. Mm-hmm. And if you don't know if your organization's a 501c3, you could go to their website and they'll pretty much let you know if they're a 501c3. One thing that we see very often in business is somebody makes a deduction. We say, no, you can't get that deduction. They say, why? I said, that's to somebody's personal GoFundMe page, for example. So that would be something that's not allowable. After that, it's pretty easy. Make sure you keep your receipts. If you get audited, you need to be able to have substantiation of those receipts. You are able to make a donation of non-cash donations, so maybe artwork or something along those lines. If you do that, you do need an appraisal to go along with that. Mm-hmm. So that's really the ins and outs of the charitable donation side of things. And again, as you'll hear me say many times, please talk to your tax advisor to make sure this fits your personal situation.
Absolutely. This has been in the news a lot lately, so I wanted to bring this one up. Can you explain to us how a Roth conversion works and who would benefit from this strategy the most?
Absolutely. Very popular topic that we're discussing a lot these days. So basically, here's how a Roth conversion works. Say you've been funding a traditional IRA account over time. As you know, you get the deduction for what you contribute to that account currently on your tax return. But then any appreciation and those deductions grow in the account, hopefully. But when you go to take them out, they come out and they're taxable. Okay. Whereas the money that's sitting in the Roth IRA, you don't get the current deduction for, but as it grows, that growth, the appreciation and the principal you put in comes out tax-free. So the question is, do we take the traditional IRA and convert that to a Roth IRA currently? Typically, most tax strategies would be to defer any amount of taxes you could pay, but there are situations where it could be beneficial to pay that tax now. So let's talk about who might be a good candidate. So a good candidate would be somebody that maybe is in a lower tax bracket currently than they will be when they start taking the contributions out. That could be facts and circumstances. Maybe this wasn't a good year, it could have been COVID related, and you're in a lower tax bracket and than what you would anticipate when those amounts start coming out. Or it could be a change in the effective tax rate, the statutory tax rates that are applied by the federal government. So those two things need to be considered. One other very important item is if you want to maximize what you're leaving your heirs. So if I have that traditional IRA, maybe I could convert it now, pay tax while I'm still alive, but upon my passing, it's now in a Roth, and that would go to my beneficiaries, my children, and they would have no tax burden associated with that. One other reason is maybe for just some diversification in your retirement accounts. So if you have all of your money in a traditional IRA and that's going to be taxable when you pull it out, maybe you could take some of that and sort of hedge your bets and put some of it into a Roth and keep some of it in the traditional and have a little bit of hedge in terms of what the future tax rates could be. So those are candidates of people who should do it. People that shouldn't do it is if you're nearing retirement and you're taking your required minimum distributions to cover your living expenses. That's something where it wouldn't make sense to accelerate the tax on today. You also have to have money to pay the tax. So if you know after-tax dollars sitting around to pay the tax, you're not a good candidate for this as well. And then finally, I would say if your strategy on your required minimum distributions is to give to charity, there's a funding mechanism where you could have your required minimum distribution go right to what we call a QCD. It's a qualified charitable donation. So the total amount of your distribution wouldn't be taxed because it's all going to charity. If that's your strategy, obviously it wouldn't make sense to accelerate the tax on that as well. But again, as always, talk to your tax advisor.
Absolutely. So I have a follow-up question on that. I'm sure that our viewers know, and I know that you know, that a few rules have changed with the traditional IRA, where if you inherit a traditional IRA now, you have to distribute that and take distribution from an IRA in the 10-year period, unless you were a spouse or related party. Was that same rule applied to a Roth IRA?
It does not.
It does not. So that would be a great advantage as well.
Absolutely, that's a great point.
Yeah, so thank you. Many times, our clients want to gift assets to their loved ones or to the favorite charity. Can you provide us with the details of what they should know in regards to this strategy? What is the best approach with this strategy and what to look out for?
Well, absolutely. I think we touched a little bit on the charity side, so let's go to the loved one side. So currently, in 2021, the estate tax threshold is $11.7 million for an individual and $23.4 million for a couple. So anything in excess of that amount would currently be taxed as an estate tax. And those rates on just the federal level are just about 40%. And then there's some additional taxes that could kick in if there's a generation skipping transfer. But let's just put 40% out there for now. And these amounts are also set to sunset in 2025. So what the threshold will be, it's bounced around around over time in my career, but I think the going knowledge would be that it's not going to be any higher. It's probably going to be something lower in the future. So this is a great time to look at your estate and see if there's any gifting strategies that could be implemented to get those assets out of your estate. So a couple things to look at. There are some easy, I would call them, tax-free gifting opportunities. The first would be annual exclusion gifts. So right now you're allowed to make a gift to an individual of $15,000 individually. And as a couple, that could be $30,000. This would trigger no reporting either on your side or the beneficiary side of that gift. These are allowable gifts under the code. So for example, if you and your wife, you have 2 kids and maybe 3 grandchildren, each of you and your wife could gift each one of them $30,000. So 2 kids, 3 grandkids, it's $150,000 of gifting per year you could do. So it's a pretty sizable amount and a good way to begin to get money out of your estate. There's also something called medical and educational gifts. I don't see a lot on the medical side, but on the educational side, it's a way for a parent or a grandparent to pay the cost of their child's education directly to the institution and not have that go into your lifetime exclusion amount either. So this is easy ways to do it. If you're looking to make a bigger dent and you want to make a larger, more substantive gift, that's allowable as well. But most likely what it will do is trigger a gift tax return. So let's say that same situation, instead of $30,000 for your 2 kids and 3 grandchildren, you want to make it $100,000 each. So it's above the minimum. So a gift tax return would be required, but no tax would be paid. This would just eat into your lifetime exclusion of when the estate tax would kick in. So very doable. All you would be needed at that point in time was to file a gift tax return. So you're really paying no tax. You're pretty much just out of pocket whatever you would have to pay your tax provider to prepare the gift tax return. So finally, other gifting opportunities that are out there, they're obviously 529 plans. We've talked about those before in terms of gifting, getting a tax donation possibly for a New York plan, and getting some money into your kids or grandkids' names to pay for college. And then there's also situations where you want to begin that gift, but you maybe don't want the younger child to have control of those dollars. So we look at things like a uniform transfer for minors account where you could start funding that. The child might not necessarily know about it, but however, when they reach either the age of 18 or 21, they would know and have full custody of those plans. So at that point in time, it's really their money. So, but just different gifting opportunities to consider.
This is very helpful, and thank you for that. Any other strategies, Mark, that you think we should be looking at for this year while we plan for our taxes?
Absolutely. So I would recommend everyone take a look at your withholdings. So if you do receive a W-2 from your employer, take a look at where those withholdings are. You know, everybody gives a decent estimate of what they think they want to come out, but the IRS actually has a very good item on their website where you could go estimate what the tax withholdings are versus your income, put in some other variables, and have a generic idea if you're going to get a refund or have to owe substantially come April. Those withholding tables have moved around a lot over the years, so I really recommend people take a look at that now. There's certain amounts that you could pay in advance as well. As an individual, we're all cash basis taxpayers. So if there's items that we could accelerate to pay to pay out, maybe you could prepay a mortgage payment. If you're a Schedule C person that's taxed along those ways, you could maybe prepay your rent or other expenses that you would be allowed to deduct on your return are things that you could accelerate into 2021 to lessen your tax burden. 2 final things, Rajiv, near and dear to your heart. You could take a look at your investment portfolio, talk to your advisor, see if there's any tax harvesting that could be done in your portfolio. So if you have maybe realized some capital gains during the year, capital gain distributions from mutual funds are a big thing this time of the year. What do those look like? And if there are other positions in your portfolio that are maybe at an unrealized loss, we could sell those, realize the loss to offset any capital gains. And finally, and probably most importantly, I'd say just take a look at any contributions you can make to a retirement plan. If you're not maxing out your 401k through your provider right now, and you have the ability to do that, that's an adjustment you could make here in going into the last month of the year, to maximize any retirement contributions to help reduce your income and pay less tax.
That makes a lot of sense. And just to touch on tax loss selling, as we mentioned before, just like Mark is mentioning, we at Parks Capital actively do the tax loss management in the fourth quarter. So we make sure that we are realizing those losses for the benefit of but if you have accounts outside of Parks Capital, make sure you use that strategy and realize the most you can. So thank you, Mark.
Sure.
Of course, we cannot close this discussion without having a brief discussion on the proposed legislation regarding taxes in Washington right now. What is your view on where this proposal is going and things our clients should really focus on to prepare for any changes to the tax code next year?
Rajiv, I wish I knew. It's a very fluid situation, and I would tell everybody to keep an eye on the news that's coming out of Washington as things continue to develop. There's obviously been a lot thrown at us the last couple of years, and there's going to be more. Specifically, the infrastructure tax bill, the infrastructure bill that was just passed has very few tax provisions in it. There's an end to the employee retention credit. There's some further requirements for unbrokers for some crypto asset reporting. But that's about it. But what I envision is when 2022 comes, the budget reconciliation process will address some of the more hot topics in the tax world, things like the child tax credit, the earned income tax credit, premium tax credit, and most importantly, which has been a real moving target, is what the amount of the state and local tax cap is, or what's known as the SALT cap deduction right now that is set at $10,000. There's a lot of talk about that number moving, being eliminated. I've heard a $60,000 number, so more to come on that. But I do think this first bill, the infrastructure bill, didn't have a lot, but 2022 at this budget reconciliation, there's going to be more changes coming.
Yes, definitely a very interesting time from a tax point of view and a tax planning point of view. Yes, thank you so much for that, Mark. So let's talk about small business owners a little bit. As a small business owner without any employees, you always have a choice. Should I open a SEP account or a 401k individual 401k account? From your point of view, from a tax point, which one is more beneficial for a small business owner?
Oh, great question. The quick answer is the solo 401k would be the way to go from a tax advantage perspective, because you could basically contribute more to that type of plan than a SEP account. Taking a step back, very important to set at least one of them up. A great tax planning tool. But basically, to compare the SEP account, the back of the napkin math is just about 25% of your adjusted earnings in a SEP account can be contributed to the account for retirement purposes, and you could get the deduction for. As opposed to a solo 401k where it's $19,500 plus approximately 25% of your earnings on that. So just a real quick example is, if you're a small business owner, you have a Schedule C that you're under 50 and your Schedule C nets you about $100,000 in net income. The SEP contribution would be approximately $19,000 that you could make. Same identical situation with the solo 401k, $100,000, you're under age 50, your contribution could approach $38,000. So almost double. So some significant tax advantages to setting up the solo 401k. In addition to that, the solo 401k has a loan provision, so you could take a loan out just similar to like what you would do in a normal 401k plan at work, and there also is a Roth option in the plan.
So a lot more flexibility.
Absolutely.
Okay, thank you for that. And just so you know, we do solo 401ks here at Parks Capital often for clients, so they're easy to set up and get started with, as easy as the SEP account as well. So recently, New York State mandated that all private employers in New York offer retirement plans for their employees. Can you expand on, from a tax point of view? I mean, we understand that it's a good benefit for the employees, but from a tax point of view, for an employer, what would be the big benefit of opening a 401k for their employees?
Sure. The main item is that any contributions to the plan would be deductible on the company's books and records. So whether it be a profit sharing contribution or a match, those items that the company's contributing to is an allowable deduction on their corporate or partnership tax return. But again, I don't think the tax tail should wag the dog here. I think the most beneficial part is, as you mentioned, from an employee retention standpoint, attracting the top talent and offering a good benefits plan would probably be as beneficial as the tax savings would be.
Right. Well, that makes sense. Thank you. But as a business owner, you're always looking for tax benefits on everything that we do. So it's worth asking.
Absolutely.
Okay, so many of our clients are successful business owners who would like to offer more benefits to their employees while also accelerating their own retirement saving in their peak earning years. Can you expand on this concept of cash balance plan option that can help clients save even more for retirement and save for their employees?
Yep, another great question. The cash balance plan we've seen taken hold a lot of late. It's a great mechanism to tremendously expand the amount that you could put away for retirement as a business owner, and as you mentioned, help your employees. It's a qualified plan under the Internal Revenue Code section. It's basically a twist on the old defined benefit plan, where as opposed to the 401k plan, where your investment choices and how you allocate your funds and invest your funds are individualized. All these assets are pulled together in a trust account and managed appropriately. Pretty conservatively in terms of its nature, but we could get into that in a little bit. So as I mentioned, this is a great funding mechanism. I'd say on average, we'd see individual accounts being funded to the tune of probably between $100,000 and $250,000 per participant. So maybe a good way to break this down is to see who would be a good candidate for a plan like this. And owners basically looking to defer over $60,000 in retirement contributions, this is ideal for. So right now you could have a current plan, you could max out if you're over age 50, your contributions, approximately $65,000 a year. If you're looking to do something in excess of that, then you would need to look to an option like a cash balance plan to do that. As I mentioned, there's an employee portion. So an ideal candidate is an owner that works for a business that has historically contributed on behalf of their employees, either through a match or through a profit sharing contribution. And if they're not doing that, they need to be a company that's willing to do that in order to make this work. Also, because of the funding needed every year, you want to make sure the company is consistently profitable, so that they have the money available to pay the contributions that are needed. And again, it could be offered with other plans, but basically what we're seeing is a lot of professional service firms are using this. The owners are maybe over 40, 45, 50 years old, haven't traditionally saved a lot for retirement in their earlier years, either just covering their living expenses, paying for college, things like that, and now are in a position where they could contribute more to their retirement. So they're ideal candidates for a cash balance plan like this.
That's wonderful. So to sum it up, basically someone who is able to contribute to their own retirement able and willing to contribute more than $60,000, has the cash flow to maintain that contribution over time through their business, and is willing and able to contribute to their employees on a consistent basis in addition to what they're doing right now in employee benefits. Would that make sense?
Absolutely.
Right.
And like anything else I said, make sure you talk to your tax advisor first.
Absolutely.
There's a lot of moving parts here.
Yes. Any other strategies, Mark, you think we should be looking at or doing for this year from a business point of view?
Absolutely. The first thing that comes to my mind with moving tax rates, changing both for individual tax rates and corporate tax rates, how pass-through entity taxation works, it's a great time to look at your business and determine if your entity selection is appropriate. So there's a single member LLCs and sole proprietors, S corporations, partnerships, C corporations. You want to make sure that your business entity selection is correct. And it might be different today than when you initially set up your business, so it's a good thing to review. I would also review your retirement plan that you have with your business. Is it the most beneficial? We've talked a lot about retirement plan structure today. Is what you're offering for yourself as an owner and your employees the best that's out there today? I would put in a plug for all the accountants out there too. Make sure your bookkeeping is sound.
Oh, absolutely.
You have the right people in there and you've got accurate numbers to report on. Very important. And then finally, and this has been something that's stayed the course over time, the ability to claim first year depreciation on any capital improvements that you purchased during the year. So basically, if you wanted to go out and you had to buy a new dump truck and you're in the construction business, you could write off the entirety of that purchase rather than having to depreciate that over time.
Right.
It's a big deal. So what I recommend people do is, here we are, we're approaching the end of the year. Maybe you do have some capital improvements scheduled for the first quarter of 2022, but you've got some profitability in 2021. Maybe it makes sense to accelerate that purchase into 2021 so you could write it off and reduce your taxable income for the current year.
That makes a lot of sense. Thank you, Mark. Thank you, Mark, for all of your guidance and for your time today. Before we go, we would like to encourage all of our clients to review their tax strategies and call us with any questions. But of course, as Mark says, discuss your strategies with your own CPA. Thank you so much for watching, and thank you, Mark, for being here today.
Appreciate it.
Here at Parks Capital, we strongly believe that a successful investor is an educated investor. For this purpose, we've created our own YouTube channel. Education plus investing equals success.